Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On the program tonight, I catch up with Adam Dawes of Shaw and Partners, and I want to know whether we should be buying this dip with confidence or not. And we'll then talk to the CEO of Aussie Broadband at a time when there are question marks over whether Telstra's share price can sustain its current levels and whether it actually is doing as good a job as it should be for both businesses and residential customers. And finally, I catch up with the American fund manager by the name of Chris Questa. He's from a company called THB Asset Management. They buy small and micro cap companies in the US. Micro cap companies are pretty big in the US. And I want to know whether he thinks he's got good reason to be worried about all this bubble talk about artificial intelligence and whether he sees a bit of a rotation going on in the US from the big tech, the big companies, into the smaller companies that have been largely neglected when you look at the relative rises, the percentage rises of big cap stocks compared to smaller cap stocks. That's an issue I think is really relevant here in Australia. I think the rotation is important to the sustaining rise of the Aussie market going to 2026. And it's often good to see the same parallels going on in the US market. So let's kick off with Adam Dawes of Shaw and Partners. Adam Dawes, thanks for joining us.
It's great to be here, Peter. Thanks so much.
Pleasure. Now, mate, the big question, nice market rebound today. Is this the dip we have to have, or will there be more dips on more anxiety, or do we just say, yep, December 10 rate cut, rolling into a Christmas rally, Santa Claus rally? Don't you love Americans?
Well, the Santa Claus rally, as I said the other day, it better hurry up. Like literally, it is we are literally running out of time for this rally. Look, I think any dip is good to buy because what it does show that there is resilience in this market, and it definitely shows that the Australian market is not down and out. And it was a lot of those tech stocks that have been hit really, really hard. And now they're starting to come back. Xero's looking really good at the moment. In fact, I bought some for clients today. I was happy to miss it out at 35, but I bought some at 38 because I feel that rally can be extended back up, as well as 360 was 35 to 38, not Xero. But I've been buying some 360 and Xero today for clients. I do feel that this is probably a good time to start stepping into some of those tech stocks that have been badly beaten up. But as far as a broader market rally, the lithiums came off a little bit today. I just think it's a broader market rally. I think you got to be a little bit careful, and stock picking is going to be essential coming into Christmas and the Christmas rally.
Yeah. Well, what I find fascinating, mate, is that a product that I've been recommending for a year or so, X20, has done really well because it picked up the rotation trade as interest rates were coming off the boil. And of course, now the interest rates are coming off the boil. The question is, will X20 still be a good performer for the year? I still think the rotation story is still going to be pretty strong. Are you with me on this?
Yeah, agree. I mean, you've got the big four banks that have, they've already done their run. They're struggling. You've got the major miners, obviously US dollar coming down, but major miners are still continuing to struggle as well. I think that X20 or that X50 is going to look quite well because that's where the value really is in our market, is in that minus the top 20 stocks. And that's, I think, yeah, absolutely. So I'm comfortable with that trade. And I think some of those stocks actually look really, really quite good. And remember, 75% of the volume is traded in the top 50 stocks. Now, take out your 20, that still leaves you another 30 stocks there with lots of volume going through to meet that and to mark that. Even the VAS, which is the Vanguard ETF 300, has done exceptionally well. All you're doing is taking out the sort of the big names, which is the Woolies, the banks, the resources, and I want everything else in that market to move. So, yeah, I think it's still an okay trade at the moment.
And what I find fascinating, mate, is for the VAS thing, I agree that the banks, they're coming down, and they won't, super will probably come down by more than most, but eventually they'll hit a bottom. But when I had a quick look at the top 20 stocks that the analysts still think there's upside, and it's quite fascinating because you got Wesfarmers 8%. Aristocrat, I think, is just in the top 20 now. BHP, Aristocrat is 27%. BHP 12. Brambles 15. Coles 11. CSL, of course, 36. Goodman 30. Macquarie 30. Northern Star 5. Sigma. So the top 20, the other half are going to do really badly, as you pointed out, but the other half would be okay. So it's not going to be terrible, and that will feed into VAS, as you made the point. And at last 100, at 201 to 300 to 300. There's going to be a lot of great performing companies there. Now, but this is the next important question is, we know the second year of a US presidency is not usually a good one. I think Shane Oliver made the point last week that the average drawdown in the second year is 17%. But that is on the basis that you have a normal US president. We don't have. This guy is an unusual. I'm not being disrespectful, but he's an unusual. And therefore, for people like us who've used economic criteria, investment criteria, and all that sort of stuff to work out what's going to go on, he could come up with a curveball like he's one big, beautiful bill. He's got his financial deregulation and anything else he can pull out. So that could mean that 2026 does permit room for our rotation that we're talking about. Do you see my point?
Yeah, so like I've been looking at a couple of other brokers' research, UBS, JP Morgan, and Morgan Stanley, all actually point to 2026 to be actually a very good year for markets. And they're really bullish on the back of that tech will continue to rally. Now we've seen a pullback, but it will continue to rally. Plus then business, with Trump, it's all about business. Business conditions will be reduced so that there's freer flow going forward. And so a lot of big analysts, and you've got to look at these guys, UBS, JP Morgan, Morgan Stanley, they know what they're talking about. And their light pages is about 80 pages, and their full deck is over 300 pages of charts and why they come to these kinds of these assumptions on how the next year is going to go. So look, it did leave me with a little bit of confidence that potentially that next year is going to be okay. However, on the flip side, we've got interest rates, and I think that's the biggest thing: inflation, job numbers, all of those things are going to come there. But I think next year we will be okay. It will be more volatile, and that's probably what's going to unnerve a lot of investors: is the volatility that as we climb the wall of worry again, is going to be a little bit more volatile. So I think just investors need to sort of stay clear with what they're buying, understand why they're buying it, and hold the line. Because I do feel that 2026 is going to be okay, but with more volatility, and that might shake some investors, or unnerve some investors going forward.
I looked at some of the interesting and big names in the X20, and you've alluded to them already, but I just wanted to give you what the analysts were saying. We got tell me if you agree or disagree, not with the number, but with the magnitude of the positivity around these stocks. So they've got zero. This is a consensus view, 67.8%.
Yep. Upside, you mean? Yeah, upside. Yeah. Absolutely. I think.
Yeah, I'm not asking you for an agreement on the size of the number, but the magnitude of positivity, and so 67.8. Get a yep from you on that?
Yeah, definitely.
Technology 1, 17.9.
Yeah, it might be a little bit harder. I think the market's getting a little bit long in the tooth on T&E, but I still think it's a very good business. So, we could definitely get there.
Life 360, 42.
Definitely. I've been buying some today on that. Yep.
Peak, 26%.
Yep. Have with that.
Light and Wonder, 34%.
Just got to be careful with this court case. It's still going to take a couple of more months. And if they find out that they're using Aristocrat's algorithms, we got to be a little bit careful on that one, but I will say yes, because I think they should be okay.
Here's one I think you supported me with when you thought the market was too negative. James Hardy.
Yes. I only hope, because I've got a lot of money in this.
Yeah,
I'm very happy.
Yeah, so they got James Hardy at 31%, Car Group at 26%.
Yeah, that's fine. Absolutely, yeah.
Afterpay 9%.
Yeah, that's done well. Yep.
Zip 76%.
Zip will do really well as long as there's no impairments to their balance sheet. Zip will continue to do well going into Christmas. Yes.
Yeah. lower interest rates and an American shopper, you can rely on them after Thanksgiving, can't you?
Exactly.
And
Absolutely.
finally, one of my long-suffering stocks has actually come good, and I'm glad I stuck with this sucker. Mesoblast, 73%.
You're on your own on that one, Peter.
Oh, yeah, I'm laughing now. I'm laughing all over the bank on Mesoblast, but
Absolutely.
no, but what I want to make the point was there are a lot of potential movers, and I've left out other good names, like Harvey Norman and Nick Scarlett. There's so many great companies from 21 to 300. You just have to believe that if the rotation play is a goer, there's plenty of stocks to move that ETF along.
Yeah, I agree. And that ETF is perfect because, it's that extra 50 to 100 to 200. And that's where a lot of the money is made when there's value in the market. And I think that's where we are. We've had a fall. We're seeing value coming through. And I think that's where you're going to do a lot better.
Okay, so what's the latest stock that Adam Dawes just can't wait to go to work to tell his clients about? Because this is the one that's going to reinforce the greatness, and hitherto not always thought about greatness, of Adam Dawes.
Yeah, well, look, there's two actually. I mean, I'll pick the large cap and the small cap at the moment, and I think Life 360 is that one where we really should be getting behind. I think it's been hit way too hard. It's now starting to bounce, and I feel a lot more confident about that going forward. And certainly, the business as a whole, when they last reported, was a great result, but just the market was anything tech, get rid of it. And so, it did get sort of, pulled down with that overall side of things. There's a small little company on the smaller side. That was a large cap. On the smaller side, EIQ. I have spoken about this on the channel before, but it's a echo business where it's a heart echo business. They've just come out. Currently the stock's at 24, 25 cents. We've been putting a bit of money into that today under the announcement that they're looking for the reimbursement code. Plus, their technology is now 99.5% proven that it will work. And so when you're talking about your heart, you don't want to muck around. And this is something that's actually moving. So EIQ on the small end, be careful. I own some shares in this one, but it is a fantastic little story for anybody who wants a little bit high risk in the AI space.
Okay, well, what I'm going to do is I'm catching up with my good mate Ross Walker, one of the best cardiologists in the country.
There you go.
We'll see if Ross is onto your EIQ.
I would be happy to get any feedback from Ross. Absolutely.
Great stuff, mate. Adam Dawes, thanks for joining us.
Thanks. Great to be here.
And that was Adam Dawes of Shaw & Partners. And now let's catch up with the CEO of Aussie Broadband, a company that's really trying to take on Telstra, particularly when it comes to small business. Everyone knows Telstra is the big player in this market. What are both the opportunities and the threats of going into bat against a company like Telstra?
Yeah, so and we've been asked this question. I've been with the company 6 years, and I've been asked this question. I think every 6 months I've been in the job, which is, when does Telstra address the diminishment of its market share that you are part of taking from them, and it hasn't dissipated to date. So the opportunity there is I think we are we remain a sort of real Aussie battler, if you like. It's a sort of a corny phrase, but we are the Aussie battler and the way we talk to our customers is all our call centers are onshore, obviously. So we have real genuine conversation with our customers. We don't script our calls other than the legal compliance we have to do. And we empower our staff to answer the questions and stay on the phone as long as I need to solve the problems. That's not obviously the business model of Telstra. So that's where the opportunity remains is our realness with people and our ability to connect with people and deliver an outcome that they're satisfied with. The threat with Telstra is obviously they've got deep pockets, and so they as they launched their new pricing yesterday with their 50% promotion discounts, that has concerned some of the market in the last 24 hours or so. We see that as a tactical thing, and they've done it before, and we've continued to gain market share. But what we do see them using the weight of their balance sheet in the E&G space, where they'll throw significant incentives at businesses to stick with them in the E&G space. But we've still managed to get decent growth in that space. So our approach is to just keep doing what we're doing, keep being different, but keep solving customers' problems, and we think the growth will continue to come.
So selling the NBN is a zero margin business. Is that a fair statement, or is it a small margin?
Small margin.
Yeah, I thought so. My producer, it can be a bit excessive at times. How do you guys plan to diversify to grow your business? Because in many ways, if you win over small businesses and they love the relationship, ultimately, you can make 80% of your business from 20% of your customers. Yeah. So what's the plan for ABB?
Yeah, so we would love to be the small business specialists in the market, and then what we've identified is that small business in particular are time poor more than anything, right? But they won't spend time on their business; they're only spending time on choosing their internet provider and things like that, right? Yeah. So for them, it just has to work. Right, but that's all they want. And if they have to pay a little bit more to guarantee that it works, they'll do that. And so we've got a range of sort of ideas as to how we might be able to do that over time. How do we package up? We bought a business that had a business called Telco in a Box. How do we package all the elements up a small business needs to present to them in one go? So whether it's it's point of sale, it's public Wi-Fi, maybe a little bit of security, a telephone line, mobile maybe, and just solid internet connection. So how do we create that enablement for small businesses? So we've got a way to go on that, but that's sort of our vision for them. But 57% of our revenue in FY25 came from residential. So we have diversified through acquisition. We've got an E&G base through a couple of acquisitions. We've got a voice business through Symbio. And which is also a business that enables other telcos. So we also want to help other telcos. We want to help the next Aussie Broadband. And in that wholesale space, we want to have our mantra is, if they win, we win. So how do we facilitate and how do we facilitate small telcos to become big telcos?
The people watching this are either going to be the small business potential customers, or they're going to be investors. Yeah,
absolutely. Yeah. Well, I'd say to them, it is easy to switch. Give it a go. See if we let you down, because we won't.
To listen to the full interview, subscribe to Diary of an Investor wherever you get your podcasts. Click the link for more.
And now I'm going to catch up with Chris Questa, who's the fund manager of a company called THB Asset Management. This is a fund that tracks and chases great quality microcap funds, stocks in the US market. Let's just see what he's seeing right now, particularly around artificial intelligence. Is it a bubble or not? And finally, is there a rotation likely to happen in the US that will keep stocks rising in 2026? Nice to meet you, Chris.
Nice to meet you too.
Yeah. Why don't you tell us about THB Asset Management?
Sure. THB was founded in 1982. 3 gentlemen, there's a person behind each one of those letters, worked together at Citigroup at the time, and they left to found THB. And
Is Citigroup in Australia or in the US?
This is in the US. And interesting, the product they were running within Citigroup was called the Special Situations Fund. Because
sounds very much like an American CIA movie, doesn't it?
I don't know about that, but what it was small and microcap equities. Because at that time in 1982, if you weren't large cap, you were other.
Yeah.
And that's where the name Special Situations comes.
Yeah.
So as a firm, we have a long lineage or history managing the smallest market caps within the United States. And so
how small are small market caps? This will shock Australians.
Sure. So the weighted average market cap of our strategy today is approximately 1.3 billion US, which is quite sizable. And in Australia, but we own companies down to 50 million US, as long as they're liquid. So it's a wide range. So quite different, but that's grown over time with US markets, and it'll continue to grow.
So what's your background?
Sure. My background, I started at Van Eck in 1995. I went to Fordham University in the US. And then there I worked on natural resource stocks. I was an analyst. And from there I went to Solomon Smith Barney. And I was an equity analyst there working on special situations.
Yeah.
interestingly enough. And then from there, I went to THB. So I've only worked at 3 firms my entire career, and been at
Still
THB.
pretty important there.
So I've been at THB since 2002.
Yeah.
So it's quite a long time.
So what's there's a lot of questions I want to ask you about
Sure.
how you invest or what
Yeah.
you see, sort of stuff. But what's your favorite special situation, discovery, investment result?
Of all time.
Yeah, of all time.
Yeah, I'll tell you one that's interesting because it touches on a lot of points about investing.
Yeah.
This was back in the U.S. I'd say it was in the early to mid 2000s.
Yeah.
And they were phasing out MTBE, which is an additive to gasoline, to unleaded petrol. And what they were replacing with was ethanol, which is an additive. It's a corn-based fuel.
Yeah, we all see it.
And so there, at the time, there was a stock, Terra Industries, which made nitrogen-based fertilizer, which goes into corn. And the stock was $3 or $4 at the time, undervalued, deep cyclical company. And I did a meeting with management, and I asked them. I said, "Well, wait a minute. They're phasing out MTBE. They're replacing with ethanol. You sell to ethanol producers. Won't that be good?" They really poo-pooed the idea. Yeah, they weren't sure, whatever. Sure enough, we ended up buying the stock, and it's a lesson I learned. Sometimes you can't even listen to management. So we bought the stock, and
sometimes you shouldn't listen to management.
yeah, exactly. And I think the stock was acquired for $45 like 2 years after that. And so it was an early lesson in my career, is that you have to make your own decisions. That even management teams sometimes can get bogged down in their own biases.
Yeah.
And you have to make your own decisions. You can't just take what they say at face value. So that was an interesting time of being ahead of it.
Yeah.
Understanding what was happening, understanding the playing field, capitalizing on it from an investment standpoint, and going, I guess, against the grain, if you will.
Yeah. The US market's been powered by growth companies, the Magnificent Seven. And the level of rotation hasn't been as good as I reckon you would have liked, because, they should be rotating to companies that benefit from lower interest rates, value companies, and it's usually a good time for small cap, isn't it?
Yes.
But there's been excessive preoccupation with these great companies that really have pretty good ideas.
Yeah.
Are you suspecting we've got at least a year in the US market where the micro caps, the smaller caps, will actually have their day in the sun? I know Russell has a good year so far, but not like S&P 500 or NASDAQ.
I think you touched on a lot of points in terms of what's driving the U.S. market, and it is cyclical. It's interesting. We've spoken to investors. It's not like Sasquatch or Bigfoot. There are cycles, small and large. We've been in this is the longest large cap cycle in U.S. history in terms of duration. And so what ends up happening is complacency sets in. Why will it ever change? And one of the parallel periods that we believe is equivalent in the U.S. market is probably the Nifty 50s, the Nifty 50 period in the early 70s, when IBM was trading at 90 times earnings. Yeah. These were great, profitable companies.
Different than the hours, weren't they?
Right, yeah. Great, profitable companies, world-class companies that at the time, if we were sitting here in 73, you'd say, well, who could ever compete with IBM? Just like you can say that about Nvidia, but the cycle changed.
Yeah.
Right. And that's one of the things that when we have the benefit of some of the original founders of THB, they invested through that period.
Yeah.
And what I've learned from them is they said it just started to melt away one day. IBM wasn't 90 times earnings anymore, whatever the multiple was, right? Yeah. It just, the multiples collapsed. They were profitable companies. The tech bubble was different in the 90s. Unprofitable companies, that was a different animal. The Nifty 50 were just world-class companies, IBM, Xerox, and it just changed. The cycle changed. And I think right now what we're seeing in the U.S. is that what's going on politically, Buy American, tariffs, starting to put new revenue sources into these smaller companies. So if you're looking for a catalyst, we think that you're seeing that catalyst now.
Yeah.
Buy American provisions, all of these things, it's ending up in these smaller companies. The other aspect that I've spoken to investors about is just lax antitrust enforcement. So that was part of our country for 20 years. So we allowed the Mag 7 to get so big through acquisition to become that big. They're not allowing them to do acquisition. So there's not another Mag 7 coming.
Yeah.
And so that really opens the door for these smaller companies again, right? Because they're not letting these mega cap companies acquire like they did back years ago.
Do you think there is an artificial intelligence bubble that we should be worried about? Or do you think it's going to be a manageable bubble? If bubbles they can actually shrink.
Yeah.
They can be burst,
Yeah.
but they can also get smaller and smaller and smaller.
Well, I mean, I think since everybody's talking about it, I think there's probably a bubble in bubble talk.
Good boy.
Right?
But still,
like, yeah. Bubbles typically don't happen when everybody sees it coming, right? So the fact that everybody's talking about it gives me some comfort. But we spoke to a host of companies, private and public, and I think the key difference on the AI side is just the applications are real time. So like you invested back in the 90s, Global Crossing. They laid the fiber that's probably powering some of our phones today in communications. But when they were laying that fiber, all that CapEx was going into the ground. You were still on a dial-up modem in your house.
Yeah.
It wasn't doing anything for you right then.
Yeah.
Real time, as this AI is being built out, you can have your iPhone have ChatGPT working, right? So the real-time application of it and the adoption rate of it and the expansion of it, I think is what sets it apart. The other thing is it's being fueled by profitable companies.
Yeah.
Whereas the tech bubble was not. So are people going to overspend? Yes. Is there some level of speculation? Yes. Every great innovation needs some speculation. Otherwise, nobody would invest. So I don't think so. Will there be one? Yes. I don't think we're there yet.
Yeah, unless there's like a recession or something really, really bad.
Yeah.
And we could be exaggerating how important a pullback in the share prices of the Magnificent Seven.
Yeah.
Let's hope we're right.
Yeah, exactly.
Nice to meet you, Chris.
Yeah, great being here. Thank you.
And that was Chris Cresta of THB Asset Management. That's the show for tonight. Thanks for joining us. Remember, if you want to catch up with my daily thoughts, go to Switzer Daily, switzer.com.au. And if you want more help with your investing, think about becoming a subscriber to the Switzer Report. Go to switzerreport.com.au.